You did everything right. You paid your entire credit card bill on time. No late fee, no interest, no missed payment. The next morning, you open your credit monitoring app and your score has dropped by 25 points. At that moment, most people assume the system is broken or unfair, but the reality is much more uncomfortable. The system worked exactly the way it was designed to work. And if you understand what just happened, you can almost predict your credit score before it updates. If you care about protecting your financial reputation and avoiding silent mistakes that cost you approvals, interest rates, and loan opportunities, subscribe now, because most people discover this only after they have already damaged their credit. The real problem is this: the day you think matters on a credit card is not the day that controls your score. People believe the due date is the most important date on a credit card. It isn't. The due date only protects you from penalties and interest. It protects your wallet, not your credit profile. Your credit score is controlled by a different day, a hidden day that almost nobody checks, and this misunderstanding is the exact reason responsible people still lose points. We naturally imagine the credit system as something that watches us continuously. We think every swipe, every payment, every decision immediately updates our record. But credit bureaus do not operate like a live broadcast. They do not track your daily life. Instead, they take a single monthly snapshot, one photograph of your account. For the next 30 days, your financial reputation is judged by that one image. Imagine spending an entire day cleaning your home. By evening, everything looks perfect. But right before you take out the trash, someone walks in and sees garbage bags sitting in the hallway. That person will believe your home is messy even though it was clean all day. Credit reporting works the same way. The system does not measure effort, responsibility, or intention. It measures what your account looked like at one specific moment. That moment is called the statement closing date. Every credit card has a billing cycle, usually between 28 and 31 days. When the cycle ends, the bank generates your statement, and at that exact moment, your balance is reported to the credit bureaus. Not your payments during the month, not your plan to pay, only the balance that exists at that second. This is where the confusion begins. Suppose your credit limit is $5,000, and during the month you spent $2,500 on travel, furniture, or an emergency repair. Even if you pay the full amount the very next day, if the statement closed while the balance was still $2,500, the bureaus record that you used 50% of your available credit. For the algorithm, that looks risky. For the next month, your report shows you as a high debt user, even though you never carried a balance or paid interest. The drop you experienced was not a punishment, it was a risk calculation. This calculation is based on a factor called credit utilization. Credit utilization measures how much of your available credit you are using at the time it is reported. The formula is simple: reported balance divided by total credit limit. The system does not care how much money you have in savings. It does not care that you plan to pay tomorrow. It only evaluates the percentage at the reporting moment. Decades of lending data show that borrowers who regularly use a large percentage of their limits are statistically more likely to miss payments later. Because of that, scoring models like FICO and VantageScore treat high utilization as a warning signal. As utilization increases, your score decreases even if every payment is perfectly on time. Here is how the ranges typically behave. Above 50% triggers strong risk signals. Around 30% is acceptable but not ideal. Below 20% is good. Below 10% is excellent. Between 1 and 5% is where the highest scoring profiles usually exist. Surprisingly, reporting 0 on every card is not always perfect either, because the system may interpret complete inactivity as lack of recent credit usage. The algorithm wants to see that you can borrow and manage credit, not that you avoid it entirely. Now you can see why people feel confused. They pay the full bill on the due date and still lose points. The reason is simple. The due date is when you avoid interest. The closing date is when the bureaus judge you. These two dates are usually separated by 2 or even 3 weeks. By the time you pay on the due date, the higher balance was already reported long ago. The solution does not require more income, another card, or complicated tricks. You only need to change timing. First, find your statement closing date. You can locate it on your monthly statement PDF or inside your banking application. Then, make a payment 2 or 3 days before that date. You are not paying early to be responsible, you are controlling what the system sees. If your balance is $1,000 and you pay $950 before the statement closes, only $50 is reported to the bureaus. In the system's eyes, your utilization becomes 5% instead of 100%, even though you use the same card exactly the same way. After the statement generates, you then pay the remaining $50 before the due date. You avoid interest, and you optimize your score at the same time. The bank records a full payment while the credit bureaus record a very small balance. Both models interpret your behavior positively. There is also a technique often called all zero except one. You allow every card to report a zero balance except one card which reports a very small amount, typically 1 to 5% of its limit. This shows active borrowing behavior without risk, and many very high score profiles naturally follow this pattern. You do not have to do this every month, but it becomes extremely powerful before applying for a car loan, personal loan, or mortgage. One billing cycle of optimized reporting can change lender perception because you are not changing your finances, you are changing the data lenders see. Credit scores are not a moral judgment, they are statistical risk predictions. Once you understand which data is actually reported, you stop guessing and start controlling outcomes. Check your statements today and locate your closing dates. The next time your score changes, it will not feel random anymore. It will feel logical, predictable, and most importantly, controllable, because you finally understand how the credit system truly evaluates you.